Does the bull market still have room to run? Our next guest says gains are getting harder to come by. We welcome Bob Dahl. He's the vice chairman of BlackRock. Bob, good to have you back on the program.
Hi, Betty.
Okay, so, we saw this whopper of a jobs report on Friday. We're now back down again, though, today. If anything, what does this tell you about the cyclical bull market that you've been talking about?
Well, Betty, we don't think it's over. We just think we're in this transition phase. I think the jobs report on Friday, among other things, was just a reminder. We're not going to have zero interest rates forever. And when expectations from investors move from very low and falling rates to, guess what, rates have to go back up, there's normally a period of adjustment as we move, if you will, from the PE or multiple-driven phase of the bull market to the one that relates to the real economy and earnings. I think that's where we are.
Bob, we were just talking about a call from Bank of America Merrill Lynch today, the S&P at around 1275 at the end of next year. Can we get an updated view from you on where you see the S&P by the end of next year?
Yeah, I don't think that number's out of question. I think it'll have a 12 handle on it, whether it's low 12s or high 12s. Fundamentals will dictate over time. But the important point is we think the path of least resistance over the next 12 months is still up. But it's not going to be a straight line as it's been from March. I think we'll have some more bumps along the way.
Hey, Bob, it's Adam. For, guys at home who are kind of wondering what to do, they may have some stocks that have run up. If, in fact, there's this period of adjustment coming up, do you sell some stuff or do you just sit tight and kind of ride it out, assuming we're going to start growing sometime middle of next year?
I think the latter. I don't think you want to wholesale move money to the sidelines. I just think you want to make sure you've got some balance in your portfolio. I see a lot of portfolios that are just heavily cyclically oriented with all these global cyclicals, and I wouldn't abandon those, but I'd make sure I'd had an anchor in the portfolio to some more conservative, higher quality, if you will, economic independent kinds of names. You can find them in healthcare, technology, lots of places.
But, Bob, is that going to be the place where you're going to get the highest return?
I think in the near term, that's probably the case. As you know, high quality has lagged since the cyclical bull market started in March. Done a little better of late, but I think that's where the value is. Most industries, you find the high-quality companies at no more expensive prices than the low-quality companies. Where can you go shopping and not have to pay up for quality? Answer, U.S. stock market. That's pretty rare.
Bob, one sector you've been cautious on the last couple of times you've joined us, financials. Based on some of the recent developments like Bank of America repaying its TARP, are you getting more bullish on the financials?
Well, I'd say just less cautious, perhaps is the best way to put it. We're still underweight in our portfolios, still believing that there are more equity issuances to come. There is a slow growth world we are in, and therefore there are going to be some people not able to pay their bills. These stocks have come a long way. We still have financial re-regulation to go through. So we think there's some gray clouds for that sector.
Yeah, and the rate hike question. I mean, are the markets being too early? Is it too early to start pricing in a rate hike?
Well, when rates are, let's call it zero for Fed funds, that's a very different starting point than 1, 2, or 3, as we've typically had at the bottom of a recession. So I think talking about it, anticipating it, is not out of the question. Who knows when, but my best guess is middle of next year.
But, Bob, could that derail the cyclical bull market you've been talking about?
I don't think it derails it. As you all observed a little bit earlier, when interest rates start going up, stock market usually goes up also. But my point is not with the same pace and not as broad a market. It is more selective when rates are moving up.
Okay, on a last note, Bob, I want to get your view on earnings predictions. We're looking at record earnings by 2011. Are we getting ahead of ourselves there?
I don't think so. Look, corporate America has done a great job at cutting costs, first of all, begun to talk about better revenue growth, and that will be the story. The margins will be there in our view. The question is, will the top line, and our guess is probably the case. Don't forget, 40% of the S&P 500 earnings come from outside the United States, where growth is a bit stronger.